For those of you who have been tracking markets post-election, you may have noticed that it's been a very active time for muni bonds, ending election week at a 3-month high. So given the moves that we've seen and with inflation concerns and fiscal deficits remaining, we have to ask, is this a good time for muni investors? And is the current trend expected to persist? We're going to break it all down for you right now on UBS Trending. Hi, everyone, and thank you for joining me. I'm Anthony Pastore, and this is UBS Trending. Please help me welcome to the studio today my guest, David Hammer, who is a managing director at PIMCO and also leads the Muni Bond Portfolio Management team. Dave, great to have you back on the show. Good to see you.
Hey, Anthony, thanks for having me this morning.
Yeah. So, I mean, listen, this is a perfect time for you to be sitting with us today because it has been a really active time for muni bonds. We sort of joked right before we started the show today, and I said it seems like muni bonds are almost trading like equities these days, especially in the election week. So, as we said, they rallied the most in 3 months right after the election, the Friday after the election, following a sharp sell-off the day before on the Thursday. So maybe you can give us a state of the union on where munis are now, how the market's looking, and talking about if this is just a kind of a post-election pattern or if there's other things going on that you're seeing.
Yeah, well, most of the damage was done in the muni market, really before the election. Post-election munis went up by about 15 to 20 basis points. They came right back down. But if you look back to September and October, the 10-year Treasury was up 60, 70 basis points. And October and September ended up being two of the biggest supply months in the history of the U.S. muni market. So lots of tax-exempt bonds for sale, and that pushed yields higher and relative valuations wider as interest rates backed up as well. To level set the muni market today, so yields are now about 40 basis points higher than where they started last year. The IG Muni Index about a 360 yield. That would be about a 6% yield on taxable equivalent basis. High yield munis at a 535, you'd have to earn 8.9% taxable equivalent. So, relatively high yields, higher than where they started the year, and continued credit improvement. Muni collections, tax collections are up 30 to 35% from pre-pandemic. Rainy day funds are still near record levels. Federal relief dollars continue to flow through 2026. We're seeing infrastructure dollars that are just beginning to flow. That's a continued tailwind. And then at the local level, most bonds are backed by property taxes, and property taxes are still catching up with house price appreciation that occurred in 2021 and 2022 and 2023. This is likely a multi-year phenomenon as tax assessors reassess the value of homes in America. That's a tailwind for local credit. So coming into this fall period, what we saw was really a good time to allocate to munis, higher yields, wider spreads, and then looking ahead, we expect supply to moderate. Technicals are typically a bit better in November, December, and January. We think that's exacerbated a bit this year because many muni issuers, they pull forward their new issuance plans ahead of the presidential election. So we think a lot of that has already occurred. Supply moderates, yields are high. The election hasn't changed our base case view here that now is a good time to invest in the muni market.
Yeah, well, let me ask you, kind of expanding a little bit more. We know some of the policies that now President-elect Trump has talked about on the campaign trail. Obviously, we'll really have to wait until day one or his first few months in office to see what policies they enact. But one of the things he has been talking about consistently are the tariffs, putting on various countries like China, for example. If that does happen and we start to see these tariffs hit Mexico, China, other countries, how will that potentially affect the muni market? Because when you look at the way that munis are connected to the ports where all the supplies and goods come in, could that maybe change your direction of where munis might be going in that arena?
Yeah, so I think a key word there is potentially. There's a lot of policy uncertainty and what looks to be a pretty narrow Republican majority in the House. Will still require some compromise to get things done. I'll start with what we know for sure, and that's that corporate tax rates likely aren't going back up. And this is probably the most important policy for the muni market. Banks used to own about a third of the market. Banks and insurance companies, that's down to 25% today. And it's going to stay there because corporate tax rates are likely to stay low. So what does that mean for us as investors? It means steeper muni curves are probably here to stay, so more value in the long end. And many of the, what I would say more interesting opportunities of the last few years is banks have stepped back as direct lenders in the muni market, real estate related assets, not rated bonds that we're directly sourcing through non-traditional channels as banks step back. That opportunity set should continue. The next thing that we're focused on here are watching how tax credits or tax cuts, I should say, are extended. Um, we do believe deficits will grow. That's a given. However, again, with the narrow Republican majority in the House, it may limit just how much. And there's a chance that munis again get caught up in this conversation as a pay for. If you recall back in 2017, ultimately the muni market, it shrunk in size. Policymakers decided to eliminate advanced refundings of municipal bonds. That shrunk the market. They used those expected savings as a pay for. There's some risk that other parts of the muni market, private activity bonds, private higher ed, potentially get caught up in that conversation this time around. On balance, that would actually be a good thing for muni investors, as it would shrink the overall supply of the market. And then turning to your point on tariffs and inflation, we do think there's probably some offsetting impact here on growth of both lower immigration combined with some tax cuts and deregulation. Tariffs would also be a potential headwind to economic growth. What won't change is the Fed, and we've had a chance to hear from the Fed since the election, and lowering rates by 25 basis points. The Fed really went out of their way to emphasize data dependence from here. So they're not going to be anticipating or reacting to potential policy changes, but really working with the data that comes in. As the economies continue to perform, that could be a more moderate path of rate cuts. But, we still do believe that there's room for the Fed to get back closer to their neutral rate, somewhere in the low threes, with the possibility to, move a little bit faster if the economy slows more than what's expected.
Right. I mean, and we're looking at inflation at this point in our story at about 2.4%. So the Fed direction seems to be working, at least for right now. And we're still seeing, jobs, even though jobs are slowing, it's still a pretty decent jobs market considering where we were just 3 or 4 years ago. So, this is probably the most important question I would ask you, David, which is, we're looking at the yield curve right now. The belly of the curve around that 5-year seems really attractive when you're looking at 5-year treasuries. We even moved the 5-year to attractive level here in CIO. So when you're looking at where rates are and we're looking at the longer end of the curve, rates are starting to go a little bit higher on the 20 and 30-year side of treasuries. Where do you like munis right now? Where are you going when you're investing? What parts are you staying away from, given where we are with rates?
Yeah, so maybe I'll start with the curve. The muni curve is very different than the treasury curve. We'd agree with you that the 5% point in the treasury market, that looks attractive. The muni market still has a lot of upward slope. 10s, 30s are about 80 basis points in positive spread. That's come down from a spread of about 120 basis points. We still like the long end of the muni market. Most bonds are also callable, so there's less interest rate duration risk than a non-callable treasury. Although I'd say we like it a little less. So we're still overweight, but where we've been reducing those overweights in the belly of the muni curve, that has cheapened a bit, back to about 70% of treasuries. There have really been some outsized opportunities to invest in non-traditional muni credits. So a few of our favorites there, pass-through mortgage tax-exempt municipal bonds. These are tax-exempt muni bonds that are ultimately guaranteed by Freddie Mac or Fannie Mae. These are yielding 3.5% to 4.5% in 5 to 10-year parts of the curve. That's about 100 to 150 basis point pickup over very traditional AA rated munis. And we think also would benefit if the muni curve did normalize a bit more. Other areas that we like right now, high quality muni high yield. It's possible in today's market to structure a portfolio to about a BBB average credit quality, 7 years of duration, 4.5% to 5% tax-free. You'd have to earn 8% pre-tax equivalent to get to those same after-tax returns. And in the taxable market, that means taking a lot more risk. In our morning meeting this morning, one thing we discussed was that corporate credit spreads are back to the tights, going all the way back to 1998. So the muni market allows not just excess yield and excess return, in some of these portions of the market, but also a much more defensive and resilient risk profile if the economy does slow more than what's expected. And I think that's a theme here. It's thinking about the uncertainty ahead, and how individual investments we're making today, how will they react if the economy experiences a harder landing than what's priced into markets today, which are quite optimistic. Some areas that we no longer like that we've reduced, areas that have really peaked in the muni market, we see more challenging times ahead. City of Chicago, the New York MTA, Puerto Rico general obligation bonds, were all quite big positions here a few years ago, and in all areas that we've reduced. And then some of the lowest quality portions of the high yield muni market that really don't hold up in our stress tests, project finance, senior living, deals with weaker covenants that may allow collateral to be moved away from a bondholder. We do see areas of risk in these parts, and now with spreads tight, it's a great time to reduce.
Excellent. David, thank you very much. I know we could go on and on with more. There's so much to the story here, but I think that was a great rundown for our viewers. Thanks for joining us, David. Love to have you back on again in the start of the new year, just to kind of see where we are, especially as we're looking at supplies and through the end of the year and into 2025. So thanks for joining me, David.
Thanks, Anthony.
Yeah, my pleasure. Good to have you, and we'll hopefully have you back soon again. That was David Hammer from PIMCO, the lead portfolio manager for muni bonds there at that firm. And as you know, we have great partnerships with PIMCO and lots of other firms. You can find more information from them and others, including our chief investment office, on our website, ubs.com/views. You can also follow UBS on social media. We're on all the channels, including LinkedIn, Facebook, and Twitter. Plus, you can check out our dedicated channel on Instagram at UBS Trending. And as always, if you have questions about your portfolio, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.